You have a massive opportunity in front of you right now. And I'm not talking about just any old opportunity that will come and go. No, this is a once in a lifetime type of opportunity. And if you don't start right now, you're going to miss it, completely miss it. And you're going to wish you did this sooner. And I'm talking about investing. If you just graduated college, you are in the best time of your life to actually invest. The reason for this is because you're making or going to make the most money you ever have in your life. And so by making more money, you can invest money, and you're still young. And so by being young, you have this opportunity to use time. You have time on your side in order to invest for a long time and make big returns. So stick with me today because I'm going to be going over 3 reasons right now is the best time to start investing after you graduate college. So let's jump into it. Like I said, this is the biggest opportunity that you will have because you have your sidekick, time, on your side. So please do not screw this up. Take notes and stick to the end, because if you do not get the second and third steps, the reasons on why you should actually start investing, this first reason that I'm about to tell you will not matter. So let's jump into it. The first step, the first reason that you should start investing right after you graduate college is because you make the most money you ever have. And so you have this money, so what do you do with it? You create a mindset. And what I mean by this is you create a mindset so that you don't have lifestyle inflation already in your finances. Do you know what lifestyle inflation is? Lifestyle inflation is when you make more money, so you spend more money. If I make more money, say I make $5,000 extra dollars, mentally and emotionally, I feel like I should be able to go and spend $5,000 on whatever I want, and it won't affect my finances. But that is wrong. Because the way that people get rich, the way that millionaires and billionaires get rich and actually get wealthy in order to retire early or set themselves up for financial freedom is actually by taking that extra income that they already weren't used to making or having and then putting that money into investments. That's putting money into stocks and assets that's actually going to get them a return. So now you are graduating college, meaning that you invested in yourself in order to get a degree so you can get a better job and career that you make more money. You're going to have more expenses, but your career choice should outweigh those decisions. So let's say that you're going to make $5,000 a month now because you have a good paying job. You have a good career. You just graduated college and your salary is $60,000 a month or a year. That means that you're going to make $5,000 a month. Well, let's say your rent is $1,500 and all your other expenses are, say, $1,500. That means that you have $2,000 now to go and invest. Now, I know that's your gross pay, but you can do the same math off of your net pay. You're going to want to invest that extra income first. You set your budget up. You don't have your lifestyle inflation. You invest first, and then you set your budget up so that now everything flows off of your pay, your net pay after investing. And that's why it's so crucial, because you want to create the mindset. It's a very hard shift and a very hard pattern to change when you're spending all your money and then you invest the rest, compared to investing first and then spending the rest of your money on your bills, your wants, and your needs. So now you have a mindset that I want to invest because I'm not going to let lifestyle inflation actually creep up on me. And that leads me to the second reason that you need to start investing now. And remember, I said you have a sidekick in time? That's awesome. You also have another sidekick, and that's called being more risky. When you have time on your side, that means you have a lot more time that you can actually invest in the market. meaning that the volatility of the market going up and down does not affect your portfolio as much because you have that time on your side. So one year, maybe you go up 20%, and the next year you're up only 2%. And then next year's a really bad year, and maybe the markets have some kind of crisis and they're down 10%. And then they're back up 20% or 12% or 8%. You get what I'm saying? You have longer time in the market, meaning you can ride this roller coaster, these waves up and down and up and down, and it doesn't affect you as much. You can also be more risky. As you're more risky, you have a better chance to get higher rewards. The risk reward turnoff is a lot bigger, meaning that you can invest in riskier assets. Maybe it's crypto. Maybe it's just really risky stocks. Maybe it's just companies that you would not actually invest in if someone said, hey, you're retiring in 5 years and you need to make this much money every single year in order to retire. You'd be a lot more passive. You wouldn't be as aggressive. But being young, you can be aggressive. You can go after and go for those risky things, because if you lose it all, guess what? You still have a lot more time than someone that's 30, 40, 50, 60. You have so much more time, and so you're able to be more risky in the markets, meaning that you might be able to get a big reward in something. Maybe, get kind of a little bit lucky, hit those rewards, and be able to retire early. People that take risks are the ones that grow. People that are able to jump off and take a leap of faith, those are the ones that you hear the stories of, like, hey, he invested this much money and it ended up being this massive amount of money and he retired. If you're 60, you're not going to want to do that, because then you're going to be risking all your money and you won't have the time to recover. 5 years is not really a lot of time to be able to recover an entire portfolio, because you don't have the time on your side. But luckily for you, like I said, you have the time on your side. So that's tip number 2. The second reason you want to start investing right now is you have time on your side, meaning you can be more risky, which might equal more rewards in your future. Now, if you've listened through the first 2 reasons to invest right out of college, this third reason is the most important reason, and that is the value of your dollar. What I mean by this, if you are 20 years old, every single dollar that you have right now that you are spending could be worth $88.30 when you are 65. So that means every single time that you go to the grocery store or you go to Starbucks and you get a cup of coffee and you hand them a $5 bill, that means that's actually over $400 when you're 65. So the mental game of this is only $1 right now seems like it's not that much. But if I were to say, hey, that coffee costs $88, would you still buy it? Would you still go to the convenience store and spend $15 on snacks? Maybe. But I'm saying you have to have that mindset of this is how much the money is in the future. That's why you hear a lot of financial people say, don't make those small transactions, don't go get coffee every single day. And I'm not saying you need to cut everything out. I'm not saying that, because I know you also need to live a little bit of life. But I'm also saying that you just need to be wary and have that mindset. Think about it next time that you are spending $5 every single day on coffee. And so I actually did an example right here. I'm actually going to read it to you. So if I were to spend $12 on breakfast and coffee every single day, I went to Starbucks, I went through the drive-through line, it made me feel better, it made me have a good start of my day for work. That's awesome. It's $12. It's only $12, not that much money. But $12 for the entire year. I'm talking every single day. So it might be a little bit exaggerated, but just stick with me. So for the entire year, you would have 365 days, 12, you would be at $4,380 for the year. Not bad. That's a lot of coffee and breakfast that make you happy. It's only $4,380 for the entire year. Now, if you were to have that money and invest it for the year and not touch it again, you would have $386,973 after 45 years. $386,973, all off of 1 year of $4,380, where you invest it right now when you're 20 and you don't touch it again. That is the power of compound interest. That is the power of actually starting right now. Now, let's say you waited. You said, I'm not going to invest yet. I want to wait. I want to spend money. I'm just not graduating college. I want to feel good. I want to be happy. Cool. Not going to judge you. Most people do that. The average person does that. But here on this channel, I am trying to build a community. I want to build a community, help people, help others. I just want people to be financially free, and it is not about being average. Because we don't want to be average. We don't want to be in credit card debt. We don't want to not have investments. We don't want to get to 65 and have to work a part-time job or a full-time job. No, we actually want to retire early. We want to have investments early. We want to be set up for financially so that we can go on vacation when we want. We don't need the credit card in order to pay for the vacation and then I have to pay it off for 12 months. We don't want that. We want to live financially free and have as much exposable income as possible so that we aren't trapped. We aren't anxious. We aren't stressed about finances when you have to put a new water heater in your house, when you have to go take your car into the shop. Yeah, does it suck? Yes. Not saying it doesn't suck still. I'm saying, but you have peace of mind because you're blessed by God to have that money because you're making the right decisions and following Him faithfully. And so, like I said, $4,380 would be for the entire year of going to Starbucks and getting breakfast and coffee at $12. That would turn out to be $386,973 if you were 20 years old and you invested that money. Now, let's look at 30 years old. If you're 30 years old and you invest the same money, that value, instead of it being $88 per dollar that you're spending now at 20, your value of your dollar would only multiply by 23 times. Still a lot. It's still good. I'm not saying that's not good, but I'm saying $23 is a lot less than $88. That's a quarter of that. That means that your investment would actually only grow, instead of it being almost $400,000, it would be about $100,000. Not saying that's not bad, but it's a lot less. And that's why it's important to know the value of the dollar that you can have in the future when you're making these types of purchases, because it might change your mind a little bit when you are spending that money all the time. So what do I do? Here's what I would do. If I'm in your shoes, just graduated college, I want to invest early, I want to be financially free one day, I'm setting up my 401k for my work to max out dollar for dollar. If it's 5%, I'm maxing that out. Whatever the max match is for your job, I'm maxing that out. After you do that, I am then opening up a brokerage account. Where do you open up a brokerage account? You can go to Vanguard, Fidelity, all these different companies have brokerage account. And if you want to see a future video on that, comment down below why or what you're wanting to see, and I'll make a future video on that. But basically, you're going to go and open up a brokerage account and open up a Roth IRA, meaning that it's a tax-free growth investment. So you're going to invest post-tax dollars, and then it'll grow tax-free, and then you can pull it out in the future. It can be a small amount, just as long as you're contributing and making a mindset, putting in the effort to actually do it consistently so that you're getting returns over the long haul. I mean, remember, $1 will equal 88 if you're 20 years old. So if you go and put $10 in, that's over $800 when you're 65. I feel like that's a pretty good investment. So you're maxing out your 401k, the match. You're opening up a Roth IRA, and then you're young. So if you have more income that you want to invest, maybe you go and take a little bit riskier type of investment. Maybe you mess around with trading or something. Not saying that's what you need to do. I'm just saying you have the freedom to do it because you are young. You can lose that money and then grow it back over the long haul. And so what I'm saying is just start investing now. If I were to redo it, I would try to invest at 16 as early as possible, knowing that my dollar is going to grow longer and longer. If you like this video and now you want to invest, I'm actually going to put a video right here. It's going to go over what types of investments there are, mutual funds, index funds, and ETFs. So watch that video because you're going to want to know how to invest now. Since you know you should, you want to know how to invest. So watch that video and then comment down below what you want to see in future videos, what you're confused about, and make sure you hit that subscribe button because I'm going to be dropping videos every couple days, probably 2 to 3 times a week, if not more than that. And remember, guys, you can do all things through him that give you strength. Peace.